Welcome to Work is Good, the CSM podcast. My name is Landon Buteau, and I host the show with my dad, Chris Buteau, the owner and president at CSM. So today's episode is our real estate and mortgage market update. We're going to try to keep doing these every other week, alternating every other Tuesday here. And on the in-between Tuesdays, we'll keep going with our mortgage question of the week and just plug away at one simple mortgage principle that we think is relevant for everyone to understand without getting too deep in the weeds. So this week is our mortgage market update, and please enjoy today's conversation. And remember that if you want to work with CSM to help you get a mortgage, go to clevelandstreet.com. Okay, Dad, we are back. It is Wednesday, March 29th, and just today I got this question, and I've gotten it a little bit recently. So for our market update, I want to just get a sense from you of where rates are going in the next year. Do we expect them to go back down? What are we expecting with rates in the next year?
Yeah, it's a really good question. It's a great time to have this question because I think the events of this first quarter of 2023 really illustrate well why we always have such a hard time answering this question. Okay, because you'll see the whole market thinks, early January rates were starting to tease in the fives, right? We were starting to tease in the high fives, and we're thinking, oh wow, we're seeing that. Mm-hmm. It's turning around. Thinking the Fed's starting to talk about easing off, and then the February jobs report comes out, and it surprises the market, right? It's a big surprise to the market. It's much stronger than what was expected, and then rates pop up sharply, And the point there is that when people say, should I lock? This is obviously when that question becomes most urgent. When people they get into contract to buy, or they're going to do a refinance, and should I lock today? Should I wait a week or two? It's going to take 2 weeks, 3 weeks to close this loan. Should I wait? And my answer is always lock today. Mm-hmm. The best time to lock is now, because this is the only rate you know about. Mm-hmm. And I've said this before, I'm a believer in the efficient market theory, which is that the market is always processing 100% of what it knows in the current price. Mm-hmm. And by definition, only unknown things will change that. Things that aren't knowable right now will change that. And so we saw February, this big jobs report came. Nobody was expecting, not many people were expecting that. And all of a sudden, rates pop up. Yeah. And so then we're all back in this that feels pretty systemic. It's jobs. Then we got another month's reports jobs, and still pretty solid. Some inflation readings come in. They're not as optimistic as we'd hoped. And so everybody's then, we're a month later, and now we're thinking, rates are going up again, and we're not really looking at. And then the Silicon Valley Bank fails. Yeah. And then boom, that unsettles the market. And when the market gets unsettled, people fly to safety, and safety tends to be things like treasury bonds or mortgage-backed securities. Mm-hmm. And when people invest in mortgage-backed securities, rates go down. Yeah. So then we started flirting with the low sixes again. Yeah. And now we're kind of back easing up because people are digesting that. Okay, it looks like the Fed got ahead of that curve, and we're not going to see massive bank failures, and so so right now, rates are right about the mid sixes. I think the market is back to some kind of an equilibrium where the Fed did in their last meeting suggest that they changed their wording a little bit. They suggested that they may be able to to back off a little bit on the increasing of interest rates into the future. I think that gave the market some pause, but I think it's just as ephemeral as what they said 2 months ago. Right. So things could change with new unknown events that happen in the future. But I do think it's significant that the Fed said that. That means that they're seeing data. They're not just looking at, the Silicon Valley Bank failed and now we're toast. And so now we have to, let we have to let interest rates go down again. I think they looked at that, and they looked at what they're doing with inflation, and I think they feel like things are coming under control a bit, or we feel like we're getting ahead of that inflation curve, and maybe we can see the point in which we'll be done increasing rates. So my general sense, and I'll add one more thing to this. My general sense is that yes, rates are coming down. One of the most objective ways that you can see what the market expects is looking at rate sheets. Normally, if you want to pay points to buy the rate down, when rates are low, banks will charge you, banks will charge you a lot of money to buy the rate down, because they know that low rate, if you buy it even further down, you're going to be in that loan for a long time. It's not likely that rates are going to go even below that low rate that you have right now, that you bought down even further, so that you'll refinance out of that rate. So you're going to have that low rate for a very long time. So if you ask the bank, say, look, what if I pay you extra money up front in points to buy the rate lower on a permanent basis? They're going to charge you a lot of money to do that, because they need to make up for that lower interest rate. They need to make sure they make up for that, because you're going to be in that low rate for a long time for them.
Right.
But when rates are high, the opposite happens. And so banks will say, look, I'm more than happy to let you buy the rate down from 6.5 to 6.125, because we think that in less than a year or so, the rates are going to be back down in the 5s again, and you're going to refinance anyway.
Yeah.
So, pay me extra money now and take a lower rate, because you're not going to be in that loan that long. And I did the math with a client I had yesterday. And I was kind of surprised, but I just told them that was the fact. But I was surprised when I did the math on a break even. We looked at buying the rate down from like 7 to 6, and it didn't cost a lot at all. The amount that it cost to buy down the rate a full point didn't cost much at all, and the break even point was 1.67 years. So basically the bank is saying that you pay us enough money right now that if you still have that loan in a year and a half, a little over a year and a half, we're going to lose money. So the bank clearly expects rates to go down and people not to be in those loans that long, and they're going to be refinancing out. So they'll take your extra money right now up front. The normal break even is closer to 5 years, where the bank will charge you discount points and break even in 5 years. So I think the market thinks rates are coming down. I think in general they have kind of, they started to nick 7s earlier, and we've obviously seen it come down from that. So I think the general trend is good.
Yeah.
But on any 30-day period, it could be anything.
Right. Yeah. Yeah. It's I always hedge big time for multiple reasons. One, because I'm new and have plenty of reason to hedge for that alone, and then 2, because I always hear you say that no one really knows.
Yeah.
And so, it's interesting to hear like the reasoning behind it though, and how you look at what lenders are doing to figure out what they think as well.
Right.
Because it is so, like, even just thinking about what determines mortgage rates, and it's still to me so complicated.
It will never not be.
Yeah.
No amount of experience.
Yeah.
There's so many factors.
Yeah.
It's the world, right? It's politics, it's economics, it's military, there are so many things that can sharply affect interest rates that it's just not, it's really not possible to ever say, okay, we've got it all figured out. So. Yep.
Well, I do feel like that was helpful, though. I got a little bit more of a sense of kind of why. Like, I've known, yes, we generally expect, and it seems like most people expect in the next year things going down, but it's helpful to break down the events that have gone into that and what's going on. Cool. Thanks, Dan. Thanks for listening to Work is Good. If you enjoyed it, share it with someone else, leave a review, and listen next week.